Welcome to this webinar, NHS Pensions Explained, Setting Yourself Up for the Future, brought to you by SBK Healthcare and in collaboration with the Money and Pensions Service. To view future online courses, webinars and forums, please do visit our website at www.sbk-healthcare.co.uk. And for further information regarding your pensions, please do visit the MoneyHelper website at www.moneyhelper.org.uk/pensions. Thank you.
As Vanessa said, my name is Kath Laycock and I'm a technical specialist at Money and Pension Service on MoneyHelper. So Money and Pension Service is the organisation name. MoneyHelper is our customer facing brand. My colleague Janice is going to be doing the presentation with me as well. And as mentioned, we've got Brian Gannon, who is another technical specialist who's going to be answering your questions in the Q&A box as we go along. So we're all used to dealing with questions from members of the public on a daily basis, on an individual basis. So we answer questions about the NHS scheme, but all of the pension schemes as well. So if I explain who MoneyHelper are, we are a free impartial service that's provided by the government in order to provide guidance on financial matters. And our website is really a great starting point for any financial queries and lots of other matters, especially as all the links and telephone numbers are safe to use and no one's going to try and sell you anything or get hold of your personal information to pass to anyone else when you're using our site. So although Janice and I and Brian know a lot about pensions and quite a lot about the NHS scheme, it is a complicated scheme with different rules for different sections of the membership. So we would encourage you to check any points that you're not sure about with the NHS scheme administrators before you make any decisions or sign any paperwork. We can provide that free and impartial advice on anything related to pensions, and we get excellent feedback across our service for doing just that. What we don't do is provide financial or legal advice, and for that you would need a regulated advisor, and there are links on this slide to point you in the right direction for those. So as Vanessa and Sarah have mentioned, you will get a copy of these slides after the event, and so any links in these slides will work for you when you get the PDF version. So hopefully that will be useful for you in the future. On various slides we've got links. So what we're going to cover today, so we're going to focus on pensions and specifically why are private pensions a good way to save for the future and how much money are you going to need for your retirement. And then we'll talk a little bit about how menopause can affect your pension, and that relates to other areas of life where you might want to reduce your hours and so on as well. Talk about what kind of pensions there are and specifically how the NHS pension scheme arrangements work as well. We'll talk about how a final salary scheme works and also the 2015 scheme. Then we'll cover a couple of other extra bits, such as what happens to your pension when you die. That's always a concern for people, and how you might want to save more into your pension. And then we've had some announcements about the changes for 2023. So we'll talk about those. We'll talk a little bit about the retirement process and how you might want to trace old pensions and how you can spot pension scams. Give you a few pointers of what to do in the future, and then give you details as well of how to contact us. Now, we did look at the questions from when you registered. A lot of you said, what kind of information you'd like to know about. What we're not going to include in this main presentation is information really about the annual allowance and lifetime allowance. If we do have time at the end, we can discuss that. Otherwise, please do contact our helpline, and that can be a better way often to talk about these things, as it's quite a tailored situation that's relevant to you yourself if you're close to hitting those targets. Okay, so if we start off then by thinking about, why is it important to pay into a private pension? Why is that a good way to save? So although the state pension is going to be very useful in retirement, most of us will be hoping for more money than the £10,600 a year that the state pension is going to give us to live on. So that's the new rates as from April this year. And this is where a private pension comes in. And the other important part of it is that with the rising state pension age, the fact that you can access your private pension much earlier than your state pension age is also going to be a really important factor for many people. And currently state pension age is 66. That's going to be rising to 68 for people born from 1978 onwards. That timeline might be getting brought forward again. So the minimum age that you can take a private pension now is 55, and that's planned to rise, so it's 10 years below your state pension age. So if you want to retire early, that's up to 10 years of being supported by your private pension before the state pension kicks in. Why else is it a good idea? So one of the key things about pensions rather than general savings is that you get tax relief on your pension contributions at your marginal income tax rate, so the rate that you pay income tax. And you're also getting employer contributions too when you're in a workplace scheme. So in the NHS, the employer and the government are paying in up to an extra 20% or over on top of your salary into the pension scheme to help provide those benefits. So when you take your pension, you're going to have the choice of taking up to a quarter of the value as a tax-free lump sum. The rest of the money will be used to provide that guaranteed income for the rest of your life. And there's also death benefits that are payable to your loved ones as well. Now, in the box on the right, we just wanted to point out that although the contribution rate might be stated as a certain percentage, which is determined by your salary band, it actually costs you less than that in reality. So due to the tax relief you get, the amount you pay isn't necessarily, or the real cost to you isn't necessarily the amount that's stated. So in this example, a 7.7% contribution from a £26,000 a year salary, on the face of it would cost £167 a month. But the real cost is actually £133.60. And that's because if you didn't pay that money into the pension scheme, you'd be taxed on it. But because the money is going into a pension scheme, no tax is taken, and the whole amount goes to provide your pension benefits. So that works the same way for any pension scheme that you're paying into. So taking that into account, it's an effective cost of about 6.2% of your salary rather than that 7.7%. That's how much extra you get in your pay packet if you opted out of the scheme, and we're going to show you what you get for your money later. Janice will talk about the benefits of the scheme. How much do we need in retirement? Now, I'm not going to go through this slide in detail as we've got a lot to get through today, but we're often asked about how much a person needs to live on. Obviously, that really depends on your circumstances and what you're used to, but these figures might give you a ballpark figure if you've really no idea what to aim for at all. And so, for example, a single person living outside London might need over £23,000 a year to have a moderate standard of living. So that's the standard of living. It's described in the links on the slide there. To have maybe a second-hand car, go out a few times a month, take 1 or 2 holidays a year, and so on. So you can look at these links for further information on what this actually means and have a better think perhaps about what standard of living you're aiming at in retirement. You can also look at, how much you're receiving at the moment and how much you might need to live on if you weren't paying the pension contribution, your national insurance, and the housing costs that you're paying at the moment. So if you look forward to what it might look like in retirement. Okay, so pensions and menopause. Well, what's the link there? So about 400,000 people, women, start menopause each year. And over 70% of them will feel that their performance at work is likely to be affected. 25% of those women will experience severe or life-changing symptoms, such that they consider giving up work as a result of those symptoms. And it's estimated that 1 million women have left the workplace due to menopause symptoms. 23% of women who have symptoms have left work as a result, So it is something that can have a severe effect on individuals, but of course employers such as the NHS are taking this seriously as well, because it really affects a workforce, especially when there's a majority of that workforce being women. So how can menopause actually affect your pension? What is that connection there? So any of us, of course, might want to change our jobs any time in our lives, all sorts of different reasons. And the issues that we're going to cover here will also be relevant to people who perhaps have other health issues or have caring responsibilities, or really anyone who's making choices about their career and work pattern, and these might have financial implications. So if you're reducing your hours, if you're retiring early, that is going to have a financial effect. And menopause is a time when many women and transgender people will struggle with their jobs. And if that's the case, it's really important to think about all of your options at that time, especially as it's really complicated and a lot of these decisions will be irreversible. So options such as retiring early or reducing your hours don't just affect your current income, but they're going to affect the income for the rest of your life. So you really need to consider things carefully. Early retirement, for example, has a double whammy effect because you're paying into the pension for less time, but you're also spreading out that pension for longer. So you're going to get less per year. And that could be significantly reduced by, say, taking your retirement 5 years earlier than you were planning to do. And as I said, that reduction will apply throughout the rest of your life. So when you're making these decisions, it's really important to think about not just the current situation, not just the next few years, but the rest of your life, your whole retirement. And of course, your symptoms for menopause and for other illnesses might be temporary and might be treatable. So thinking of it as a long-term but temporary condition rather than a permanent change might be useful as well. And it's especially important to give yourself time to think about this calmly, because we can have brain fog, anxiety, fatigue, and other issues that can affect our ability to make decisions. Now, Janice is going to explain about how your NHS scheme works shortly, and understanding your options and helping and knowing that you can talk them through with me and my colleagues without any judgment might be helpful to you as well. So do please get in touch if you need to talk through your options. Now, at MoneyHelper, as I said, we don't provide financial advice, but it is safe to say we would strongly suggest that you take time to think about any decisions relating to your pension. And it's particularly important not to rush into anything if you're feeling exhausted, stressed, hopeless, or overwhelmed. Hopefully, your menopause symptoms will be temporary and you can ask for help from your GP or menopause clinic to help cope with symptoms. And you can also speak to your employer about options that will help you remain in work. And if you're too ill to work, you can consider sick leave. Maybe if you feel you need a longer break, you can ask about a career break. Maybe a temporary role change or reasonable adjustments will be all that's needed to help you cope. If you do decide to change your job, do make sure that you consider the full benefit package, including pensions, when you look at what a job will pay you. The NHS pension is a really valuable benefit and it shouldn't be ignored. But if you're able to, you can consider paying more into a pension when you can afford it to help compensate for time out of the workplace or working part-time later on. So I'll now hand over to Janice, who will talk more about how pension schemes work and especially the NHS pension scheme.
Thanks, Kath. Yeah, so we're going to look at pension schemes themselves now. So we're going to start off with the different types of pensions that you can come across during your working life. And the first one we're going to have a look at is a type of scheme known as defined benefit, also known as DB, or even final salary. And the NHS is a classic example of this type of scheme. What they're designed to do is offer you a guaranteed form of income that is based on a set calculation that's in the scheme rules. And that income is then designed, as Kath says, to pay you for the rest of your life. You do get a few options when you're thinking about doing this. You can either have it as just a pension, or you can have it as a reduced pension plus a tax-free lump sum. And when thinking about those options, it's important to think about the level of income that you might need. So going back to that planning that Kath was mentioning in an earlier slide. As Kath says, you can normally take your pension from the age of 55, but please do be aware that from April 2028, that is going up. So it is important to think about that when you're doing planning for the future, but also think about that reduction that can be applied. And we'll look at that in more detail later on. Now, there is more information about these types of schemes. You can see there on the slide, the word here is underlined. If you click on that when you get access to the slides, that will take you to our page, and that will just give you a bit more information about this type of scheme. Now, the other type of scheme that you can come across is known as a defined contribution, DC, or money purchase type of scheme. And this scheme tends to be more commonly found in the private sector. So a lot of private sector employers offer this, or it could be a private pension that you've set up yourself, or it could even be if you're paying AVCs into the NHS scheme. So basically what you're doing with this is you've got a pot of money that you're paying into. If your employer's involved, then they may also be paying in, and that pot of money is then invested. And the hope is that over time, that pot of money grows through investment and the amount of contributions that are being paid in. But unlike an NHS scheme, it's not guaranteed, so you don't know what you're going to get at the other end. But on the other end of the scale, you've then got more flexibility about how you can take that type of scheme. So the options range from having a regular income to having flexibility to taking it all out in one go. And there are options that go in between all that as well. So it is important to think about that type of scheme because there's lots of factors that go into how that works. Again, you can take money out from the age of 55, as you can with the defined benefits types of schemes. And again, you do get that 25% tax-free lump sum. Again, you can get more information about those by just clicking on the bottom here on that slide. Next, thanks, Kath. So the NHS scheme. The NHS scheme is set up of 3 sections, and it depends on when you join the NHS as to whether or not you'll be in 1, 2, or even all 3 of these sections. So it is important to have a look at your total reward statements. That will tell you which sections you're in. And the reason why this is important is because, as you can see here on the slide, each of the 3 sections works in a very slightly different way to each other. So the legacy schemes, the 95 section and 2008 section, they are what's known as final salary. Now, a lot of people tend to call this type of scheme a final salary scheme. It's not. That's not a technical name for them. It's a way that they are calculated, but it's an easy, recognisable way of describing a defined benefit scheme like the NHS. So with the 95 section and the 2008 section, they are final salary, and they use an accrual rate to help calculate what pension you'll get based on a definition of your final salary. They can have different normal retirement ages. So you can see there with the 95 section, their typical normal retirement age is 60, but dependent on certain factors, it could even be 55 or 50. And the 2008 section has a normal retirement age of 65. Now, with both of them, you can get tax-free cash. However, there's a slight difference with these 2 schemes because with the 95 section, you get an automatic tax-free lump sum of 3 times your annual pension, and you can increase that, and I'll explain that in a little bit. But with the 2008 section, you don't get that automatic tax-free lump sum, but you can exchange some of your pension to get that tax-free lump sum. Now, then in 2015, there was a report done with regards to the public sector schemes. And what this report stated was that they were looking at changing the way in which it was calculated. So in 2015, they changed from final salary to what's called career average, or CARE. And CARE actually stands for career average revalued earnings. So this is a slightly different way of doing the calculation. Because this time they don't look at a definition of your final salary towards the end of your career. They're looking at your salary each year that you're building up, and we'll explain that a little bit more because it can seem a bit complicated. With the 2015 section, your normal retirement age is now linked to your state pension age. So if your state pension age is 66, that's the normal retirement age for your 2015 benefits. If you're like myself and your state pension age will be 68, then your normal pension age for this section will be 68. You'll see also that the accrual rate is different for the 2015 scheme. So it is important to be aware of which section you're in, because you can see here, just from these very brief points, there are differences between each one, and that can have an impact on the calculations that are done. So, Kath, thank you. So something else that you may have heard of is a public service pension reform called McLeod. Now, when they did the changeover in 2015, there were some people who were close to retirement that were offered the chance to stay in those legacy schemes, so the 95 or 2008 schemes. However, there was a court case done and it was found that this was discriminatory on the grounds of age. So that meant that all public sector schemes had to fix this. So at the moment, there is a huge exercise going on to put a fix in place. So from 2022, they put everybody into the 2015 scheme. And then from 2022 onwards, you've all been building up in that. But there's a period between 2015 and 2022 where, for those of you that had continuous service during that period and may continue to do so now, you will have the option, when you choose to take your benefits, of taking your benefits either calculated under the old legacy scheme or calculated under the new care scheme. So that's something that you will need to think about, and it's something that's currently being worked on. At the moment, it's not in place until October this year, because it is a huge exercise for them to do. You'll see in the green box there that there's a couple of links that will give you more information around this in this particular section. Okay, so with regards to the McLeod, there isn't anything that you need to do to either delay or bring forward your retirement. When you do go to retire, if you are affected by the McLeod judgment and you had service between 15 and 22, they will offer you that choice of how to do the calculation. So they'll provide you with that information to help you make that decision. Any benefits that you've got within the 95 or 2008 schemes, they will retain that final salary link, and you can still access them under all the current rules. So if you were part of the 95 section and you had an early retirement age of 60, then that would still be there. It's not going to be affected. So that means that you don't need to worry about bringing forward your retirement. Your total reward statements at the moment, they will be pre-McLeod, in the pre-McLeod position. That's because this exercise is still ongoing. They're still getting everything worked out. Once everything has been fixed, then they'll update your statements to show the updated figures. But again, you don't need to delay your retirement, because what they'll do is they'll give you that retrospective choice. So don't worry too much about it. But if you have got any questions about it, do feel free to either come to ourselves or go to the NHS scheme and just ask. Okay. Now, we're going to talk about how the two different types of schemes work. So the final salary scheme, so this is your 95 or 2008 section. This is basically where you get a amount of pension based on your pensionable service, your salary, and that accrual rate. So you can see there in the purple box, some people might call it pink, but I'm going to call it purple. There's just a quick example of how a final salary scheme works. So we've got here Lisa, who's a member of the 95 section. She has been in the scheme for 25 years and she has a salary of £40,000 a year. So the calculation is very straightforward. 25 years times by her salary of 40,000 divided by the accrual rate of 80ths. So that then gives Lisa a pension of £12,500 a year from her normal retirement age of 60. She then automatically gets that 3 times lump sum, so she'll get £37,500 as well. Now, if Lisa wants more tax-free cash than £37,500, what she can do is give up some of that £12,500 to boost up her tax-free cash. Now, when you think about doing things like that, it is important to think about the effect on your annual pension and that planning for the future to make sure that you do have enough income going on. For people who have got 95 and 2008 benefits, then those are still linked to your current salary, so that can have a knock-on impact if you're thinking about things like changing your hours, that kind of thing. So it is important to think about that. So think back to what Kath was saying about how things like the menopause and any form of illness could affect your working hours. If you do think about reducing them, it can have that knock-on impact to your 2008 and 95 benefits, because they're looking at the salaries towards the end of your career. So it is important just to bear that in mind. Okay, so you can see here, as we say, there's a few things just to bear in mind when you're looking at reducing your hours. For example, if you reduced your hours to half your full-time hours, then you're going to build up half of your pensionable service for each calendar year. So that is naturally going to have that knock-on impact. It's not going to reduce your previous years of service, but it's going to affect the ones going forward. However, your pay, if you reduce that can affect your previous years. So reducing your rate of pay, it may not have that immediate effect, but it is important that you check with the pension scheme to see what impact that might have for you in the future. Okay. So the 2015 scheme, so this is the new one that everybody is on. So as I said, this is a career average revalued earnings scheme. And what they're doing here is, instead of looking at your pensionable salary for towards the end of your career, they're actually looking at it for each year that you're in the scheme. So it's almost like building blocks. So if we have a look at this example, you can see on the screen. So I'm just going to go back to Lisa again. So she's now in the 2015 scheme, and in the first year of her membership to this scheme, she's on a salary of £30,000. So the calculation is very straightforward. It's her salary of 30,000 divided by the accrual rate of 54. So that then gives Lisa a first year's pension of £555.56. Now then, I can see a typo, so please do ignore the typo. Then in her second year of membership, her salary goes up to £31,000 a year. So then in her second year, her salary is 31 divided by 54, so that's the accrual rate. So her second year of pension is now £574.07. Now, before we add the first year to the second year, we actually increase that first year to help with inflation. So the first year is increased by an increase set out by Treasury. So we're going to use an example of 5%. And then what they do is they add an extra 1.5% onto that. So for this example, we're going to increase Lisa's first year of pension by 6.5%. So you can see there that by doing that, that's increased Lisa's first year of pension to £591.67. So when you then add the increased year one to the year two pension, she's now got a pension of £1,165.74. And that's the process that will happen for each year that Lisa is a member of the 2015 scheme. So this is why we call it building blocks, because you can see there for each year that Lisa's in this scheme, she's building up a continual building block of pension. And each year will be increased in line with inflation to help. So if Lisa has then been in the 2015 scheme for 10 years, then she could have built up a pension of £7,500 a year, following that example that we just had on the previous slide. Now, with the 2015 scheme, because they're looking at your salary for each year, what might happen is that some people might actually build up higher benefits in the 2015 scheme than they would under the final salary scheme. So this is why it is important to look at your total reward statement. As well as building up your pension, Lisa can give up some of that pension to have a tax-free lump sum as well as the pension. And the standard rule is that for every £1 of pension that Lisa would give up, she would get £12 of a lump sum. So that could also be another valuable asset for Lisa as well. So we're just going to have a quick look at an example of early retirement and why it is so important to think about whether or not this is right for you. Because whilst it is a tempting option, it is irreversible. So this is why it is so important to do your sums. So if we just go back to Lisa and that original calculation of her benefits within the 95 section. So as we said, Lisa had a pension of £12,500 a year, plus that lump sum of 37.5, if she did 25 years service and retired at her normal retirement age of 60. Now, Lisa's thinking about the possibility of retiring a little bit earlier. So she's looking at the possible retirement of 55. So if Lisa then decides to retire with 20 years service, but still on a salary of £40,000, then Lisa then has the calculation of 20 times by 40 divided by 80, and then has an early retirement factor applied to those benefits. So you can see there that with that early retirement factor applied, Lisa's salary drops to £7,900 a year from 55, plus that lump sum of 3 times her salary, her pension, sorry. So this is why doing your sums is so important, because as Kath says, you've got a double whammy effect happening here. Lisa isn't building up as much pension because she's retiring 5 years early, and then the scheme is applying an early retirement factor because Lisa has chosen to retire earlier. So it is important to think about that pension that she gets at 55 and think about how that moves forward for her during retirement. Think about the fact that retirement can last for 20, 30, or even possibly 40 years in some instances. And think back to the slide at the very start of the presentation when Kath was showing you the amount of income that we need during retirement. Depending on the standard of living you want, sometimes that can be quite a lot of money each year. So it is important to think about what it is you need your pension to help provide you with, but not just the NHS pension, but any other pensions as well. Your state pension is another staple part of retirement. So it's important to look at what you're going to get from that. If you do have other pensions from other employers, also think about those and how they can help you achieve retirement as well. So what I'm going to do now is, hopefully that's just giving you a very quick guide to the NHS scheme. I know that we have gone through it quite quickly, but there's a lot to try and get in, and we want to give you plenty of time to ask questions. So I'm just going to pass you back to Kath, who's going to take you through the next part of the presentation.
Okay, thank you very much. So I did mention earlier that death benefits are a part of the advantages of a private pension as well. And those will vary depending on whether you're still an active member of the scheme, whether you're a deferred member, i.e. you've stopped paying in but you haven't taken your pension yet, or whether you're a pensioner member. So, and the different schemes will have slightly different rules as well. So this is very much an overview. Do check out on your benefit statements, your total reward statement, what it would mean to you for your particular situation. So if you die while still an employee and paying into the scheme, your beneficiary can receive a death in service lump sum equal to 2 times your annual salary. And your beneficiary will be your spouse or your partner unless you specify otherwise. You can specify someone else. And the lump sum will be paid tax-free if you pass away under the age of 75. And other lump sum death benefits are also paid out to members who have left the scheme or who are within the first 5 years of receiving a pension from the scheme. Now, as long as you've been a member for at least 2 years, a spouse or a partner can also receive a dependence pension in the event of your death. And this calculation will depend upon whether you're an active member at the time of death. And your beneficiary would also receive a short-term pension if you died when you're in active service, and that would provide 6 months worth of your salary going forwards. So those are all really important benefits that would really help your loved ones through a difficult time. And it's really important to let the trustees of this scheme and any other pensions that you're a member of know who your beneficiary should be and whether you have a partner. And you can do this by completing a nomination form, and there's a link there on the slide to take you to that page. Now, we mentioned, possibility of paying more into the scheme when you've got, the opportunity to do that. And there's 3 ways you can do that. So firstly, you can buy chunks of additional pension, and the cost will depend upon your age. So you'll need to ask for a quotation of, if I wanted to get so much extra per year, how much would that cost me? You also have the option to build up a defined contribution pension pot, and that could be either within the NHS scheme as an AVC or take out a separate individual pension. And you'll get tax relief on your contributions and build up a flexible pension to take alongside or separately from your main scheme benefits. And finally, if you plan to retire before state pension age, you can pay extra into the scheme so that retirement reduction on the 2015 scheme would be less than it's otherwise going to be. And further details on all of these can be found on the NHS website. Again, the links are shown on the screen. When considering paying extra into a scheme, you should be aware that there are limits to the total amount of pension that you can build up each year and over your lifetime before you start paying tax charges and before that tax relief doesn't no longer apply. Okay, so you'll be aware that there was a consultation at the end of last year, and the consultation has now been sort of agreed, the changes that were proposed then. So from April this year, all members, including 1995 section members, are going to have the option to retire and rejoin the 2015 scheme. There's going to be some further changes to flexible retirement from October, and I'll come back to these in a moment. And then finally, the date at which your 2015 benefits are revalued is changing. This is the most difficult to explain. I won't go into great detail because it won't make a difference to most people, but it is resolving an issue where the inflation figure used to revalue your annual career average pension, as Janice explained in the 2015 scheme, was different from the figure being used to value your benefits for this annual allowance calculation. That's the amount of pension you build up each year. These two calculations will now use the same inflation figure so that a member doesn't receive an annual allowance charge because of or made higher by the difference in using two different inflation figures in doing those calculations. So, retire and rejoin. So previously, members of the 1995 section were not allowed to take their 1995 pension benefits and then rejoin the 2015 section. From April, that's changed. The member is going to need a 24-hour break in service, but going forward, there aren't going to be any abatement rules. There's an asterisk there showing a line at the bottom. There's also going to be no service limit on the number of years that you can pay into the scheme. And there's going to be no requirement to restrict your working hours in the first month after retire and return. It also means that people who have previously taken 1995 benefits and returned to the NHS can now join the 2015 scheme if they wish. So it's a really big change that's going to affect a lot of people who have benefits in the 1995 section. There's also going to be this additional flexibility from October, and this will affect all members taking the retirement benefits if you wish to take flexible options. So the existing limit, being able to take your 2008 and 2015 benefits in what is called drawdown, there's currently a limit of that of 80% of your benefits can be taken in that way. That's going to be lifted. So you can take the full 100% of your pension without having to leave your current job. And you can also then continue to be a member of the 2015 scheme, and you would just need to reduce your pay by 10%. And again, there's a note at the bottom about people who have a protected minimum pension age of 50. If you do that between the age of 50 and 55, you will need to take 100% of your pension benefits in the 1995 section. But again, you will then be able to carry on paying into the 2015 scheme. So if we go on to kind of a summary then of what the new flexibilities are, then remember, these are always subject to the approval of your employer. You need to check whether the business will allow you to go part-time and so on. But we've talked about some of these in passing before. Stepping down to a lower level to reduce responsibility. If you're going to be receiving a lower rate of pay this can affect your final salary benefits that you built up in the 1995 and 2008 sections. So do check with a pension scheme how that might affect you. Winding down is what they call reducing the number of hours or days that you work. And this will reduce the amount that you're paying into the pension going forwards, but it won't affect your previous benefits in any of the sections. Retire and return, that's taking your pension and returning to NHS employment and paying into the 2015 scheme if you wish. Drawdown, again, currently you can take 20% to 80% of your 2008 and 2015 benefits and continue to work. This has been extended to 100% of all sections from October if you reduce your pay by 10%. And of course, you can take your pension earlier than the normal retirement date on the section you're in and get less pension per year throughout your retirement. And you can also retire later, and your 2008 and 2015 benefits will be increased because you're taking them late as well. So a quick run through of the flexibilities. Hopefully that's good news, giving you more options going forward. And I'll hand you back to Janice to complete the presentation.
Thanks, Kath. So yeah, so we're just going to have a very quick look at the retirement process because we get questions about this a lot. So one of the first things to do when you're thinking about retirement is to get an estimate of your pension benefits. So you can use your total reward statement to help you do this, and they do have calculators on the NHS website as well. So that will give you an estimate of what your pension might look like if you are thinking about retiring either at the non-retirement age or even early. So once you've got that estimate, do have a look at the retirement guide to get a feel for how your particular sections work, what kind of benefits they offer you, the death benefits, how things are calculated, the terminology, that kind of thing. So there's links there you can see to your total reward statement, the calculators, and the retirement guides themselves. Now, once you've decided on you do want to retire, you'll get given paperwork and you'll need to choose the option that you want to choose. So once you've chosen that and sent all that paperwork back, the NHS scheme will then get you set up and they'll pay you tax-free cash if you've selected it, and they'll get you set up on the payroll to have your pension paid. So your pension is paid monthly in arrears. So that means that it's paid at the end of the pay period and it is classed as taxable, the pension itself. You get your pay slips to show you what you've paid. And if you do have any tax queries, maybe you think you've been overpaid or maybe your tax doesn't look quite right, do get in contact with HMRC. They will be able to sort that out for you. Now, each April, your pension will increase, and that will happen every April for the rest of your life. And if you pass away, then as Kath says, there will be benefits that can then be passed on to your spouse, partner, or whoever your beneficiary might be. And it is important that if you have any changes to your circumstances, change of address, bank account, etc., that you do let the NHS scheme know so that they can adjust their record and make sure that your pension continues without any problems. Okay. Now, with pension schemes, they do think that today, on average, we have about 6 jobs. So it is possible that you may have more than just one pension. It is important to try and keep up to date with all these pensions. However, there are quite a few pensions out there that people haven't claimed because they've forgotten or they've lost track of over time. So if you feel that you have got pensions out there that maybe you're not sure about or you don't know where they are, then do use the pension tracing service on the gov.uk website. It's a free service. It won't tell you if you do have benefits, but what it will do is give you contact details for administrators related to certain employers. So that can be a really useful way of finding all pensions. Once you do know where all your pensions are, if they have online accounts, it's always useful to register for them. They can be good reminder systems and good useful systems to help you update details. If you do find that you've got multiple pensions and you want to think about combining them, there's no right or wrong answer to whether or not that will work for people. For some people it will, for some people they may not feel that it's right. And with the NHS scheme, it is important to be aware that they will only usually accept transfers in within the first 12 months of you being eligible to join the scheme. So that is something just to bear in mind. But if you've got a few other maybe defined contribution schemes elsewhere, you may want to think about combining those. And you can see at the bottom, there's a couple of links there. One with regards to looking for old pensions, and it'll just give you lots of hints and tips. And then the other one is just more information about pension transfers and what to think about. Now, the next thing that we just want to very quickly touch on is pension scams. This is something that's important to be aware of because unfortunately a lot of money has been scammed through pension scams. The most important thing to take from this slide is that very bottom point. If anything sounds too good to be true, it usually is. So if anybody's coming to you and offering you high investment returns, or you're under 55 and they're telling you that you can access your pension, these sorts of things are usually hallmarks of a scam. So it is important to take a step back and just have a think about it. That link for the FCA website, they have lots of useful information about how to avoid scams. So please do have a quick look on there. Now, we have given you quite a lot of information, so that here's just a few things to think about. So you can see there that if you do think you've got any old pensions, do go and trace them. Do check your state pension. As I said, it's a staple part of your retirement. It's important to make sure that you know what you're going to get. Have a look at your total reward statement or any statements that you've got for any other pensions. Have a look at what you're likely to get from them. If you're not sure about the information on them, either come to ourselves or go to the pension providers and ask questions. Also use things like pension calculators or budget planners that either the NHS or ourselves have, just to help you plan for retirement in the future, to make sure that you are on track to have the kind of retirement that you would like to have. If you're not, then is there something that you could start doing now to help you improve that? So things like paying additional contributions or building up a separate pot or paying extra money to build additional pension in your NHS scheme. And one of the very important points is to make sure that any death benefits, you have got nominations on record. It is the first thing a pension provider would go looking for if they are told that you've passed away. Now, if you do wish to speak to us at any point, we do have numerous ways that you can do that. So if you're looking for general pensions guidance, so information about the NHS scheme or just general quick questions that you have, then please do feel free to use either our phone service or our web chat service, which is the top two. The middle one, that is for people who have defined contribution schemes. So that is our PensionWise service. That is a free 1 hour appointment where we discuss defined contribution pensions and the options that you have around them. So again, if you want to book an appointment, please do use the telephone number or the online function. And then if you've got any questions about general money guidance, the bottom two are the place to go. Those are our colleagues on the other side of our organisation, and they look at they look at all these different types of topics, with the exception of retirement and pensions, but everything else on there is something that they could help you with. So you can see there's quite a lot of topics that we cover at MoneyHelper, and these topics can be something that can affect you at any given moment in time. So it is important to know that there are people out there that can help. So that is everything. So I have noticed there's been quite a few questions, and hopefully Brian's been able to get through some of them. But if there are questions that you'd like to ask, we're more than happy to answer as many as we can.
Yeah, I'll stop sharing my slide now, and Brian can come on screen and perhaps get us up to date with the questions that have been going on and if there's anything we can answer.
Hi, I'm exhausted. Thank you, everyone. I've answered 98 and there's still 23 open. So let's have a look. Unfortunately, could everyone briefly stop asking questions, because it keeps scrolling down. So I'm just going to ask everyone just very briefly to stop using the chat box. Let's have a look. If you step down and you're in the 95 pension, can you still preserve your final salary? Possibly, depending on how long you step down for, because the final salary isn't necessarily the final salary. There are sort of situations where you can average out the last 3 years. So there's an organisation called the NHS Business Services Authority, and I've put in the, can everyone see what I've been putting in the responses? Because if you can, I've put in the NHS BSA's website. And if you want to sort of try and contact them, they can give you a lot more information about what the definition of your final salary would be. Let's have a look at another one. There's a few questions which I don't know if Sarah and Vanessa might be able to help with. A few people have been asking sort of, I can't, because they're perhaps on secondment or they're not actually directly working for the NHS at the moment, they can't see their total reward statement. So I don't know if Sarah or Vanessa, either now or after the meeting, could let people know how they can access their total reward statement. Let's have a look at some more. Sorry about this, it does keep changing, all the questions keep going past me, so I'm just trying to do this. I'm obviously not going to replace Angelica Bell on the Martin Lewis programme. Right, so Richard's asked, can you offer an example of yearly pension for the 2015 scheme after a number of years service? For example, 25 to 30 years. Not really, no, Richard, because the 2015 scheme isn't based like that. The 2015 scheme, each year's, oh, actually, Vanessa would like to answer this. There you go. There you go, Vanessa.
Oh, I apologise. I'm just clearing it for you.
Oh, okay. Oh, thank you. Okay, yeah. All right, got you. Yeah. So, so basically, the way the 2015 scheme works is you build up a pension based on that year's pension, and then that year's pension is revalued between the year you earned it and your normal retirement age. So you're basically adding building blocks each year. So you can't really estimate that, Richard. It's based on each year's earnings, but your total reward statement should include how well you've done up until the, you know, that year end. Brian,
I think that you have earned yourself a well-deserved rest to sit on the panel. I'm going to ask you questions.
Oh, thank you, Vanessa.
This is very difficult to keep up with. I think you need a third-party provider to come along.
Yes, so, okay, thank you.
Lucy Corp writes, 2 years of my pension from the age of 18 to 20 appear to be missing from my pension. I've spoken to our pension office, but they are not sure how to resolve this. Who should I liaise with? I was transferred from Devon to Tornby Council and then to the NHS.
Oh, right. Okay. Well, I guess that would mean you would need to really contact both your former employer, if they still exist, and also it's possible that if the 2 years are missing, what that basically means is that the NHS Business Services Authority don't have it on their records. So it is a problem when someone goes back many, many years and you can't actually find the missing 2 years, because what you actually need, if it's all those years ago, it would probably be in the final salary scheme. So you'd need to have records of what the salary was in those years and who it was with, and that would only be available from the employer. And this is not good news, but for people, for example, who work in GP surgeries, they often have a lot of problems because GP surgeries, although they're part of the NHS, aren't as organised. They don't have like big HR departments and things like that. And it can be that the devil's own job to try and get the correct state pension. So I know that's not a very positive answer, but what you have to try and do is go back and dig back and go back in time and try and get in touch with the people who you work for and see whether they've got any records, whether their accountant's got any records or things like that. If you've got old pay slips and things like that to provide evidence, well, I don't know if Kath or Janice, you've got a different answer, but it actually is a real problem. If there are missing years from many, many years ago, it is a question of trying to look back and try and do some detective work and see if you can get any evidence from the past.
Yeah, I'd agree with that. It can be very difficult. A lot of people don't tend to keep all their paperwork from that far back. So that makes it even harder because as members, we don't have it. But then for them to try and keep it as well can make it hard. So as Brian says, it is going to be a bit of detective work, unfortunately.
Okay, well, thank you. I've got the next question is Sue Lester asks, if you step down and you're in the 1995 pension, can you still preserve your final salary?
Well, it depends on how you step down and how long for. So there are certain periods of protection based on what job you were doing and the new job. When you do step down, what we would suggest to everybody is, of course, it takes permission of the employer anyway, doesn't it? You know, you can't just decide to step down. You have to also liaise with your employer. And what we would strongly advise people to do is, as well as liaising with the employer, get in touch with the NHS Business Services Authority as well. It does give on the website lots of definitions of the different types of final salary. We don't like to give a definitive answer because although we are sort of pension experts, we're not able to sort of off the top of our head give that level of detail, and so we would very much suggest that if you are thinking of doing that, firstly speak to your employer to agree whether it's feasible, and secondly get in touch with the Business Services Authority and find out exactly what protection, if any, you've got and for how long. Certainly there can be some temporary periods where stepping down won't necessarily affect your missing years, but it's so important that you really should be, that should almost be the most important thing. It's almost more important than what your new salary is going to be.
Thank you. Hopefully this will be an easier question to answer.
Hope so.
Hazel's asked, what does
Yeah.
special class status mean and how do you know if you've got it?
I think this relates to the sort of the medical health officer, where that there are certain categories of job where people who, and this only applies, by the way, to the 95 scheme. It doesn't apply to 2008. It doesn't apply to the 2015 scheme. But for people who are in certain categories of work, it was mainly to do with sort of mental health care, where the additional stress of that job was deemed to be worthy of people being able to go at 50 rather than 55. And for people who were employed at certain times in certain roles, if they stayed in those roles, it enabled them to retire early and in fact, in some occasions, take their pension at 55 without any reduction. Normally, if you're not in a special class status and you retire from the 95 scheme at age 55, your pension is reduced because you're taking it 5 years early. The special class status means you don't suffer that reduction, and in fact you can take your pension at 50. It's not an official thing that we would know about. What you would need to do is check with your employer whether you do have that status and find out what you need to do to maintain it and what you mustn't do if you want to lose it.
Before we move on to the next question, there are ample in here to be answering, and
Yep.
Kathy is now jumped in as a background sidekick for me, answering the questions as well, which is marvelous. But for those that have to leave, thank you so much for joining us. You'll have a copy of the slides. You'll also have your recording sent to you. We're going to stay online for the next 10 or so minutes to continue answering these questions. So if you've got a question in the chat box, please do stick around if you can, because we're going to work through them. But thank you so much to those that were able to come today. So with that being said, I'd like to move on to Richard's question. So Richard asks, thank you, but he's completely confused. Just
Right.
trying to gain an idea of what sort of income to expect in 30 years upon retirement. He appreciates your answer about blocks, but he's lost as to what this would mean for years many down the line.
Okay, well, let's just take an example where someone is on a salary of £27,000 a year. Okay, so the career average scheme gives you 1/54th of that year's earnings as a pension for that year. So I chose 27,000 because if you divide it by 54, it's 500 quid. Okay, so if you were never promoted, and if we assumed, which is a big assumption at the moment, but if we assumed that your salary sort of went up in line with inflation, you can kind of ignore inflation. Because what you're trying to do is work out, what do I get in today's terms? So if, for example, you were on 27 grand and you divide it by 54, 500 quid a year, and you were in the same job for 30 years, you'd be on about 15 grand a year, wouldn't you? 30 times 500. Okay. If you get promotions or they give increases more than inflation, then you'd be on more than that in today's terms. And if your pay went down or reduced your hours or you went to a lower job, you'd get less than that. So purely as a ready reckoner, have a look at what your salary is now, divide it by 54, and take a view, Richard, on whether you think you're going to be getting higher than inflation increases over the next 25 to 30 years, or lower than inflation increases. And all you can do, Richard, is guess. You don't know, but you might have an idea. I don't know, does that make sense? Perhaps ask Vanessa and Kath and Janice, does that sort of explanation make sense, or is that not?
Yeah. For me, actually, do you know, Brian, explaining it to me on behalf of Richard, where does the 54 come from? You said divided
right.
by
So the benefit that you get for each year is 1/54th of your salary.
Right.
Yeah, that's what's called the accrual rate or the build-up rate. So it used to be an 1/80th for the 95 scheme, plus 3/80 tax. For the 2008 scheme, it's a 1/60th of your salary. And for the 2015 scheme, it's 1/54th of your annual earnings. So you divide whatever you're earning by 54, and that's that year's pension for the rest of your life when you get to your own personal state retirement age.
Okay, brilliant. Thank you. Hopefully that's helped you, Richard. Do let us know in the chat box if you've got any follow-on questions. So Yusuf asks, he's 64, planning to take his 1995 pension and continue with 2015. Would that affect my pension payment if I return to work within 24 hours? Right.
Within 24 hours? Does he mean after 24 hours? Because you can't return within 24, can you, if you want to carry on
quite
paying
possibly.
in?
Yeah,
I think you have to return. I must admit, I've been so busy answering the other questions. Can I defer to Kath or Janice about the new rules about abatement or not? And also because I was so busy answering the other questions.
Abatement is more or less disappearing. There will be some abatement for people with special class or mental health officer status. So if they retire under the age of 60, they're still going to be subject to abatement, but abatement is currently suspended until 2025 anyway. So abatement is going out of the window. At the moment, the 24-hour break is required. So from April going forwards, people in the 1995 section can take the benefits and come back sort of 24 hours later with no abatement, just a 24-hour break. There isn't the 16-hour rule that you had before, where you had to reduce your working hours in the first month after coming back. From October, we then have the further flexibility where you have the drawdown option. And so you can take up to 100% of your benefit, from 20% to 100% of your benefit, and continue to work as long as you reduce your salary by 10%. So I don't know if that answers everything.
Yeah, just out of interest, Vanessa, separately from the pension side of things, I presume if you have that 24-hour break, is it the case that in effect you're starting a new job with a new contract? So if just for example, if you were made redundant, would you only have 1 day service?
Oh, well, Richard, I think you're much better for asking the audience that.
Yeah. I just wondered. It's sorry, I didn't mean to put you on the spot. Yeah, I just wondered. Yeah.
No, but I've got some feedback from Richard. Richard says it's just clicked, and thank you so much for patience.
Oh, great, good.
Brilliant, good. Thanks, Richard. So I've got a next question. Who's best to speak to regarding the lack of advice given re my NHS pension and special class status when I left the NHS? The only advice given by my employer when I moved to a non-NHS clinical role was to leave my pension where it was.
Yeah, it's a tricky one, isn't it? Because who is best placed to discuss that with someone? The employer is in a really difficult position if they start discussing what someone should or shouldn't do with their pension, and that is asking for trouble, really, because if the employer has given advice, even sort of suggestions which could be taken as advice, then obviously that could be taken the wrong way and someone could come back and complain. So it's really difficult for a scheme administrator or an employer to really discuss pension options with people other than giving facts. At MoneyHelper, we have a little bit more leeway in being able to, I often call it, acting as a sounding board with people, so that they can say, well, this is what I'm thinking of doing, and I can ask questions about what they really want to get out of it and what the retirement plans are and that kind of thing, and we can have a conversation about that. But still, we have to be really careful to keep it at a factual level and not offer an opinion as to what someone should do. The only type of person that can tell you what you should do with your pension or anything else is a financial advisor, and for that you would need to be paying for financial advice. So it is tricky, and sometimes you think, I wish employers would provide more information, especially in cases like redundancy, to be able to give people more information about who to speak to and so on. But the rules on what an employer or pension scheme have to provide is quite minimal. So it really is on what the employer or the pension scheme thinks is appropriate at that time, and they really can't tell you what you should or shouldn't do.
Yeah. Thank you. So I've got the next question. I love this one from Marie. So she says, it may be a silly question, but that's what we're all about, silly questions. If you're receiving an NHS pension and you are eligible for a state pension, is the state pension penalised, taxed, or is your NHS pension penalised if you're receiving the state pension?
That's not a silly question. That's a good question. So the state pension is paid without tax deducted, but it is taxable. So just as an example, the personal income tax allowance at the moment in England is £12,570 a year. So just to make it easy, when you don't have a state pension, let's say your pension is £15,000 a year, most of that £15,000 a year has no income tax on it. It's just the bit above your personal allowance. Okay, so in this pretend example, 2,430 of your 15,000 is above the 12,570, so you would pay tax just on that. If you then start receiving a state pension of, let's say, 9,570, your remaining personal allowance is reduced by that figure, so you only have £3,000 a year. So if you're then on 15, instead of only 2,430 of your NHS pension being taxed, a new tax code will be generated and sent to the Business Services Authority payroll department, and they would then have to start taxing all but the first 3,000 of it. So the answer is, I don't know if penalised is the right word, but you would be taxed on more of your NHS pension in that example. And it's always that case. There's no exception whatsoever. It's always the case that the state pension is never taxed, but could lead to a tax bill elsewhere.
It's the way the HMRC look at it. They look at the state pension because they have a certain order in which they have to tax things. So they look at the state pension first, and that's why your state pension looks like it isn't being taxed, but it actually is a taxable benefit.
Thank you. So I've got time for one more question, and what I'm going to do is I'm going to couple two questions together, so because there are similar themes. One person asks that they were employed for several years with the NHS. They then left into another scheme with Nest for 2 years, and a couple of months ago they rejoined the NHS. Would you be eligible to transfer my Nest pension into the NHS scheme? They acknowledged that you said transfers had to be made within 12 months of joining the scheme, but they didn't know whether that was originally joining or rejoining period outside the NHS. The second question refers to what they describe as nominal pension pot that was achieved before they joined the NHS, and if they would be able to incorporate that into their NHS pension scheme now.
The general rule is that for 1 year after you become eligible to join an NHS pension scheme, you have that 1 year in which you can transfer in other schemes. So if she left the NHS and had a Nest pension scheme and or if she wasn't, I guess the difficult question, I don't know if you've got a view on this, Kath and Janice, but if she never left the NHS but she had to join the Nest pension scheme because she left at 60 and then in effect took the Nest. I actually don't know the answer as whether that counts as rejoining the NHS, and therefore can she or can't she add in her Nest pension?
I'd agree with that. It depends on whether the NHS scheme classes it as starting a new period of service, or do they class it as continual? Yep. And if they class it as continual, then it's possible they may say that she doesn't fall under the eligibility rules for transfer in.
So I think the answer to that question is probably something you'd have to ask the NHS Business Services Authority who administer the scheme, because us just giving you a general, well, if you've got 1 year from when you join, it's not quite that simple, is it? We're trying to find out, well, does this fall under that banner or not? So I think you would probably need to speak to the NHS Business Services Authority. I don't know on all the links. I've provided some links in the question box, but is it worth us just posting the sort of the member hub details in the normal chat box for people?
Yes, in fact, so that is a really nice segue, thanks Brian, into the resources that will be shared with you today. So there are still questions that are in the chat box, and I can still see that there are over 300 of you logged on, which is absolutely marvellous. I'm so grateful for your time. As I say, if you do want to leave, we're going to run through just a few more questions in the hope, but we will have resources shared in the chat box by Brian, and we will share them also via email at the end of the event. But if you guys are game, I'm game, we can keep answering questions. Perfect. Okay. So we have got, let's roll to the top. We have got, I've worked full-time, most from January 1996, then to 2006, took a break to raise her children. She was under the 1995 scheme. If she returned to work in 2021, is that under the 2015 scheme?
Yeah, so her 96 to 06 will be in the 95 scheme. Because she had a break of more than 5 years, I think the final salary link will be broken, and as a result her final salary will be her final salary in 2006, uplifted by inflation to an extent. Okay, so that scheme is now entirely sort of afloat, if you like, floating on a different boat on the pension sea, and then rejoining in 21, all future years from them will indeed be in the 2015 scheme.
Perfect. Oh yes, this is an interesting one. So she's been a nurse for 35 years. She spent 18 months in the private sector. Is it possible, and would it be worth buying back those 18 months now?
You can't buy them back, but what you could potentially do if you wished is you could get a quote for how much would it cost me to buy extra £250 a year. So there's no special kind of look at 18 months and see how much that costs. Instead, I wasn't able to watch the presentation, but I think there was a section on rather than AVCs, you could buy added guaranteed income. So it would just be a question of trying to get a quote. How much extra would it cost me per month to buy however much extra per year I wanted to do? Or potentially how much with a lump sum would I need to pay in?
Yeah, there was, Brian, and then there was a link
got you. Oh right, yeah, I thought there was, but I was so busy typing away, I wasn't able to concentrate on what you and Kath were saying.
You weren't listening?
But well, for once, Kath, I know I never do, but for once I had a genuine excuse. Yeah.
I'll let you off.
Would you like to add anything, Janice and Kath?
No.
No, it was just to say that link was there on the presentation. So if they wanted to use it, then they could use that link to take them straight through to the website, and it give them lots more information that will top up what Brian's just said. And I think there's also an application form on there as well for them. Perfect.
And you will receive all of the links. You'll receive a copy of the slides when we email them out to you. So keep your eyes out for those. And attendees asked, I'm in the 1995 pension. Can you increase your pension by not taking a lump sum? I know that lump sum is not taxable, so would you want to do?
It's just not an option. With the 95 scheme, there is a standard benefit of a maximum pension and a minimum lump sum. And that standard benefit, the minimum tax-free lump sum will be 3 times the maximum pension you can build up. And the only leeway you've got is actually the other way around. You can, for every £1 of income you give up, you can get £12 of extra tax-free cash, but you can't do it in reverse.
So I have got another question from, could you clarify the McLeod judgment? So previous benefits in the 1995 scheme could continue to 2022. No service break, continued employment since 1999.
Well, yeah, so basically, if the person concerned was in the 1995 scheme when and were moved across at some point between 2015 and 22, that 7-year period is called the remedy period. And all of the existing total reward statements will assume that McLeod doesn't exist at the moment. So if, for example, this person was moved across in 2015, they might have 16 years in the final salary if they joined in 99, and would now have roughly 8 years in the 2015 scheme. And what they will have the option to do is either do that or have 22 years in the final salary scheme and 1 year and counting in the other scheme. That's basically a simplified explanation of McLeod. As long as they're still employed throughout the remedy period, of course, or for part of the remedy period.
So I've got another question that says, if you're potentially going to be made redundant, I understand that you can top up your employee contributions. Can you also top up the employer's contributions?
I don't know. Can you? Do you know, Catherine?
Wouldn't that be down to the employer themselves as to whether or not they might do?
Yeah. I think that's more of an employer redundancy question. There's nothing in law that stops you giving up some of your redundancy payment and putting it into a pension scheme, but the specific rules for that would be determined by the NHS. So it wouldn't be a legal thing. That would be, well, it'd be legal, but it would be determined by the NHS and what they would offer.
On the theme of the law, Gillian has said that she's had a lot of doubling up that didn't happen, and she's lost out on the benefits of retiring at 50.
Right.
Is there a legal route to appeal? Do you know of anything that you can do? What,
so if someone thinks they haven't got the sort of the salary and the pension benefits they should have done, can you appeal? You can, if you feel it's something that you should have been entitled to that wasn't offered, you kind of have to try and work out, well, who is it that was at fault for not letting me have that? And you then complain to them. And they will then have to look at it. So if it was the employer, they would make a formal complaint to the employer. If they thought it was the fault of the pension scheme, they would make a formal complaint to the NHS BSA. And there will be internal dispute resolution procedures, like most things really. Stage 1, where they would get a response and then we'll resolve it for you. They then come back with their proposed solution. If if the person doesn't agree with that, they can then appeal a final time. And again, they may get what they want. And if they don't, if it's a pension complaint, they can go to the Ombudsman. If it's an employer complaint, the only problem is if it's something that happened when they were 50. I don't know what age they are now, but you may be timed out for things like employment tribunals and things like that. Yeah, but in terms of pensions, if you first became aware of it now, then you could potentially complain about a pension thing that happened years ago if you've only just became aware of it. And if you can show that it was reasonable, you only just became aware of it.
Perfect. Jeff, Gold Driver, wants to check some sums. So RE, the 2015 scheme, is the formula 1/50th of your pay times the number of years in the scheme divided by 12. That's your monthly pension scheme.
1/54th.
1/54th times number of years in scheme divided by 12 is the monthly pension for the scheme.
The monthly, yeah.
So Jeff's got it right. I
Yeah.
can't read it. But well done,
Fair enough.
Jeff.
Yeah, well done, Jeff. Yes, badly done, Vanessa. But I let you off because it's very hard.
Poorly
Isn't it?
read.
Very hard to look at that much stuff. As you now can feel sorry for me now.
I felt very sorry for you. In fact, do you know, I'm going to call time on this meeting.
Yeah.
It has been marvellous. I'm so grateful to the brilliant people at Money and Pensions. I'm also so grateful for our delegates today. I know that there are some unanswered questions in the chat box. We could probably keep going for a couple more hours, but it's really worthwhile knowing that this service is available. You can call them. You guys really want to talk to as many people as possible.
Yep.
So please do make the most of this amazing service that we've been able to showcase today.